Jason, Chief Technical Analyst with Toro Alerts with your weekly market update. We've seen some interesting developments this week, quite a bit of bullish signals developing, so we'll dive into quite a few charts and show you what I'm seeing. Before we jump into the charts, we saw an interesting historical development this week on the S&P 500. For the fifth time ever in the history of the S&P 500, we saw 4 consecutive days where the S&P gained 1% or more each day. And historically, when that's occurred, we've seen averages 12 months later of 28% above current conditions, and so that's definitely an interesting bullish signal in some historical data around the S&P 500. Let's go ahead and jump into the charts and see what we're seeing here recently in the markets. So the S&P 500 broke out of a wedge pattern here. We were all the way down to some Fibonacci support right around 413 just earlier this week, and really bounced off of that strongly, broke out of the wedge that we've been waiting for, and now we're starting to really see some bullish developments in the S&P 500. As long as we can stay above this wedge pattern here, if we see a small correction next week, and we want to see it probably hold above this 434 level, then we wouldn't be too concerned as long as we maintain that. But I'm expecting some possible bullish opportunities and some excellent long opportunities in the broader markets that we haven't seen in potentially 2 or 3 months now. So there could be some great opportunities going forward over the next few weeks, so we'll watch that closely. Taking a look at the NASDAQ, similar story. We broke out of a long established wedge pattern that had started out all the way back in early January, late December. Clearly broke out of that wedge pattern, very strong momentum, and we're just about up to this Fibonacci level around 351. If we can get above that level, that'll just be even more bullish potentially for the NASDAQ sector. But all sectors are actually looking really strong right now, and we're looking like, at least in the short term, there could be some great upside opportunities in the markets. Same story with the Dow Industrial Average. Industrials have done well, although we'll jump into the ratio chart here shortly that we've seen NASDAQ's actually outperformed the Dow Industrial Average and the industrial stocks recently, and that's been a pretty big trend reversal as well, because for quite a few months the tech sector and the NASDAQ broadly was one of the worst performing sectors, but over the last week it's really done exceptionally well, so we'll want to see if that continues next week. We saw some interesting developments in the Dow Jones and Transportation Average Index. We've kind of been shopping around here for quite some time, broke above a key trend line here back in November, but then broke down below those levels and started trading back in this range. But then this week we had a strong move to the upside, got clearly above this level, a very strong weekly candle, and so the Dow Jones Transportation Averages are starting to look like they have some bullish opportunities. Looking at the Russell 3000, we've been watching this chart here for a few months. We've seen a nice, consistent, steady downtrend. We were kind of looking for it to potentially hit this yellow channel in the middle. Historically, that's been the case when you break down below that 50-week moving average. But we had a pretty strong reversal this week and actually broke out of this trend channel. And so we want to watch that. If we can get back up above this 50-period moving average next week, that'll be a pretty strong signal that, at least in the short term, we might actually be looking for some nice upside in the broader markets. Taking a look at our Value Line Geometric Index, about 1,700 stocks represented here in the New York Stock Exchange. Similar story here, a big strong move broadly in the markets, bouncing off of this 593.95 level as support, getting all the way back up to this resistance level at 630, but it punched right through just barely. And so we'll want to watch next week to see if it gets back above this level. But if it can continue to rise above that 630, 631 level, that'll be a pretty bullish signal for the broader markets as well. And then we saw some huge moves in the other countries outside of the U.S. This is a chart tracking stocks in the rest of the world outside of the United States. And you can see from this chart here, we had a huge candlestick move. This is just in 1 week. We bounced off of the 200-week moving average and moved up about 7.5% just in 1 week. And so a really strong signal for countries outside of the U.S. this week. And a lot of that was driven by China. China's done some interesting kind of market manipulation with their government to support their businesses and their financial conditions, as things were getting pretty rough over there. We saw just some huge weekly candlesticks to the downside, but then this week it reversed, got out well below the 200-week moving average, but then bounced off aggressively. And a lot of the Chinese stocks really had huge weeks this week. Some stocks 20, 30, 40, 50% upside in just a matter of days. And so we'll want to see if that continues with Chinese stocks. I'm still somewhat cautious with that sector, just with the geopolitical events going on, and we're not getting along that well with China these days. So there is a little bit of discussion around possible delistings and other factors like that I think you need to be cautious in the China sector. But on a pure technical basis, the Chinese stocks are definitely looking like they're putting in a bottom and could continue to reverse and move to the upside. This is our emerging markets divided by the SPY, so this gives us in relative terms how emerging markets are performing compared to the SPY. And we did see a pretty strong move to the upside, and a lot of that was driven by the Chinese activity this week. So we want to really see that continue to materialize and move to the upside before we really are convinced that the emerging markets are actually going to be strong outperformers compared to the U.S. But at least this week it had a nice move to the upside, and we want to see if that continues going forward. Taking a look at the Russell 1000, our large caps. We're going to see in a lot of these charts, were in a pretty consistent wedge pattern to the downside. We broke above that wedge this week with a strong move just up to the 50-week moving average. So we'd like to see next week the large caps get above that, and if we can, then that would be a pretty bullish signal for our large caps in the short term. And similar story over in the small caps. Small caps have actually been in a consistent downtrend since about November of last year. Broke out of the wedge this week, actually just 2 days ago. But really for most of this week, about 4 days now, we've had a pretty strong move to the upside in small caps. And so if we can especially see small caps get back up above this trend line here at around 209, that'll be even more bullish for small caps. And I'd really probably like to see small caps get above that 209 level before I get too excited about some small cap opportunities. But I think if we can get above that 209 level, there could definitely be some opportunities in the small caps for some great upside. And then when we're looking at growth versus value, we can see that the NASDAQ and growth stocks in particular really outperform value. That's been a pretty big trend reversal, at least on this 1 weekly candlestick. All the way back in middle of November of last year, we've seen a pretty strong outperformance by industrials over growth. But growth has definitely reversed that trend, at least for this week. And so if we can see it also get back above this 1.66 level and continue to move to the upside, that'll be a pretty strong signal that growth is maybe put in at least a short-term bottom. Taking a look at our relative rotation graph, this is all the major industry sectors that we are tracking. We've added a few of the less major sectors just that have done well, just to kind of show them in relative terms. Quite a few of the winners that have actually had the best performance for the last 3 weeks have actually ended up in the weakening category. A lot of those are the metals and miners, global uranium, clean energy. All of those had some nice moves to the upside, but then all had a little bit of a correction, I believe just in the recent week. But I still think we're in a secular bull market around metals and mining, uranium, energy broadly, I think are great places to be. And clean energy is starting to look like it's got some legs, but I kind of want to see a little bit more upside momentum on that before I get too long in the clean energy space. But it makes sense that clean energy is starting to have some moves with oil prices continuing to rise rapidly. Input costs on clean energy is not rising to the same rate of change that traditional energy is. And so that can start to shift some funds over to the clean energy space as they become more viable options, because they're competing with dirty energy, and if dirty energy continues to rise in costs, we'll probably continue to see some investments going into the clean energy space. Some of the strongest sectors we've seen in the last 3 weeks still are metals and mining, even with that correction. Global uranium as well. Energy has done really well, about 9% there. Utilities and healthcare have done good. Industrials and healthcare specifically have really just kind of started to outperform, I'd say, in the last week, and so we want to watch those closely. It looks like we might see some long opportunities developing in the healthcare and industrial spaces. Let's take a look at our oil chart. A lot of volatility there. Just in these last 3 weeks, I'm not sure if we've had this level of volatility in oil in a 3-week time period in quite some time. We started out 3 weeks ago at $91 a barrel, finished at $115, got all the way up to $130 the following week, but then sold off and closed at $108. Then this last week we got all the way back down to about $94 a barrel, but then ended up reversing that and closing the week out at about 105 a barrel. And so the fact that we closed back up, even though we're in a red candlestick and down on the week, the fact that it closed above this trend line channel is a pretty bullish signal, and I would expect it to continue to look for long opportunities in the energy space and for the oil sector. Those are looking pretty bullish, and I think with all the geopolitical events still occurring, there's just no reason to start looking for exits out of the energy space right now. Commodities had a similar story. A lot of that was driven by the volatility in oil, but we saw volatility and some corrections in other commodities outside of the oil space, but also broke above this trend line channel and is even further above that trend line channel than the oil sector specifically is. And so commodities also still looking really strong here. When we're looking at our ratio chart here, RCD divided by RHS, so we're looking at this as a signal for us. Anytime we're moving up and to the right on this chart, then that's telling us that we're in a risk-on environment. Anytime we are selling off, it's a risk-off environment. And as we look at this chart, similar story as to some of the other charts. Around the middle of November is when we started to really see a defensive posturing occurring, and that really happened all the way through last week. And anytime we see a candlestick like this where there's a big tail on it, oftentimes that's a strong indication that the bottom's been put in, especially when you follow it this week with a huge move to the upside. And so at least in the short term, this is telling us that people are getting more comfortable with risk-on environment and are looking for some stock opportunities. Taking a look at our high yield corporate bond ETF, that was looking pretty bearish up until this last week, and then we had a huge reversal in the high yield corporate bonds. That's also a pretty bullish signal for the markets, especially if we can get up above this 82.50 level, so we'll be watching for that next week. And then Aussie dollar, Japanese yen. We haven't shown this chart recently, I don't believe, and one of the reasons was it was just kind of chopping around in this trading range. It's really kind of just been up and down, not giving any strong signals really since about March of this or last year, and so it's been quite some time where it's just been in a very choppy range. But then we broke up above it very strongly this week, and so that's typically Australian dollar is a risk-on currency, and Japanese yen is a defensive currency. And so anytime we see Aussie dollar outperform Japanese yen, that tells us that we're looking at a more of a risk-on environment. And so with a big strong move this week in the Aussie dollar compared to the Japanese yen, that's also a very bullish signal for the broader stock market. And then when we're looking at the high yield corporate bonds divided by traditional bonds, there's another ratio chart. This is another really strong signal, and we got, a couple weeks ago we broke below some trend line support, and so that was looking pretty bearish. But then this last week we did a huge reversal and got well back into this trading range. If we can get above this channel, that would be even more bullish signal. But as long as we're above this 0.66 on the ratio chart, when we're looking at corporate bonds versus traditional bonds, I would say that any real concerns about the markets selling off further right now can probably be put to bed as long as we're above that 0.66 ratio level. Then if we're looking at TIPS divided by IEF, so that's Treasury protected bonds divided by traditional bonds, anytime we are moving up and to the right, that's a signal that they're expecting interest rates to continue to go up, and we got very much above this level at about 1.14. Huge move last week. This week it kind of sold off a bit, but then ended up closing right about to the top of the previous week. So that's still a pretty bullish signal on our TIPS divided by IEF. Let's go ahead and take a look at our interest rates. The U.S. two-year interest rate still had a pretty strong move to the upside, but then had a bit of a pullback, ended up at about 1.95%. U.S. 10-year had a pretty strong move up as well, finished off about 2.25%, but sold off back to 2.15. And then the 30-year had probably the biggest pullback, where it got all the way up to about 2.5%, but it came all the way back down and finished the weekly candlestick out at about 2.4, which is a pretty key level here that we're watching. And so we might be seeing potentially at least a short-term pause in rates rising. We'll want to watch that closely, but this week is definitely looking like there could be at least a short-term pause in the interest rate increases based on what we're looking at. And when we look at our yield curve, we're continuing to see the yield curve sell off. We're down to about 0.21 on that ratio, and anytime we get down to the 0 level, that's a potential signal for a possible recession. So I think there's still some reason to be cautious in the longer term, but I think in the short term, it looks like there's some bullish upside opportunities in the market, but you don't want to get too complacent with that idea that the corrections are over, because I think in a longer time frame that there's still a good chance that we'll see another correction in the market. But for now, I think we're looking at some good opportunities over the next few weeks. We saw some sell-off in the dollar this week. Anytime the dollar sells off, that tends to be bullish for the market. We did bounce off of this 97.75 level, which is a key support line. So if we want to see the dollar sell off more for even a stronger signal for potential tailwinds in stocks, then we'd like to see it get back below that 97.75 level. So we'll see what develops there next week. Taking a look at the gold and silver spaces, the gold gold sector actually had a pretty strong sell-off this week, but then did bounce off of the 177 level and pull back up to about 179. Still very bullish in the gold and silver spaces, especially the miners, and I think there's a lot of upside opportunity left in those spaces, but even in bullish opportunities in those spaces, you do have corrections, and so we had a pretty strong one. We peaked out at about 193.50 on gold, sold all the way up by 8.5% down to 177. But that's definitely looking like that could be a possible bottom on that correction. And as long as we're above that 177, or really above 175 in my mind, 174.50, I'm going to be staying long in the gold and silver spaces. Silver hasn't quite taken off yet. We got all the way above this key volume trend line here, around $24 per ounce, but then sold off last week and then corrected this week. Again, just I think a short-term correction in the silver space, and I think pretty quickly we'll turn it back around to the upside. And I think over the next month or two, silver is going to be a great opportunity. Interesting development in the put-call ratio. We've been very high in put calls. Anytime we're above the 1 level, then there's people buying a lot of protection in the market. Anytime the candlesticks are down here, there's some people that are going long on stocks pretty much. And so we've been really elevated in these ranges here, but over the last couple of weeks, we've really seen it drop down to kind of more normalized levels. And so that's telling us that there's a lot less protection being bought in the market, a lot less people shorting the market. And so that's also a pretty bullish signal for our broader market in general. And then taking a look at our VIX, also a very interesting development this week. You know, we started the week out. These are daily candlesticks, so we started the week out, well above the 30 level here, and been above 30 on the VIX for quite some time. And we got down below that level this week and just continued to blow through 25 even, and so we finished the week at below 24 on the VIX, and so that's a pretty huge development, as we haven't seen the VIX below that level since mid-February, so it's been almost a month now that we haven't been below the 25 on the VIX, and so that's also looking fairly bullish in the short term for the stock market. Let's go ahead and finish it up with one of our stocks out of the Toro Alerts app. So back in February 11th, I got an alert to buy ticker AR, which is Antero Resources Corp, an energy stock. I've been buying a ton of energy stocks this year. I still think it's a great opportunity going forward. It's really been almost the only place to be, in my opinion, since the beginning of this year up until now. And so energy's been just an excellent performer. And on this one, we got the buy signal on February 11th, and that was at about $19.50 a share. And we're still in that stock based on the alerts, and we're at about $25.65 right now. And so we've seen about a 31% gain off of that stock in 38 days. So you're getting almost 1% a day off of this trade right now. So it's been an excellent trade. I'll probably be looking for a potential short-term top right around the 30.75 level on AR, but I'll be watching the Toro Alerts app just to help guide me on that decision, because there's no reason it can't go higher above that. But that's the next kind of trend line level that I'll be watching for. If I start to see it roll over there, then I'll probably take profits. But if we push right back through that level and get higher, then it could be even more opportunity in the ticker AR, Antero Resources Corporation. If you want to learn how to trade stocks and utilize our AI technology so that you can make intelligent investing decisions, download the Toro Alerts app on the App Store and make sure to utilize the promo code so you can get 1 free month. Thanks for tuning in this week, and we will see you next week.